All right. Good morning, guys. Welcome to the Smart Biz Advisors podcast. That's where we discuss everything about small businesses and entrepreneurship. I'm your host, John Jones, and today we're diving into an essential topic for every business owner, and that's understanding the basics of financial information. As always, I'm joined by my good friend and colleague, Mr. Mark Fackrell. Good morning, Mark.
Good morning, John. How are you doing today?
Excellent, excellent. I hope you're well as well.
Doing great.
So let's get started. Whether you're just starting out or looking to improve your financial literacy, this talk I think will help provide some background knowledge, some of the things you need to manage your business's finances effectively. We all know it's crucial for small business owners to understand their financials. This is going to, help you open the door on your development, plan for the future, uh, comply with regulatory requirements, get financing from banks, you name it. It's really critical that a small business person understand the basics of financial information. Now, Mark, you have 2 decades of this kind of experience. So I think it's incumbent on you to help us lead this discussion. We want to help everyone that's listening start to understand the basics and the importance of understanding financial information. So with that, I'd like you to kind of give us an introduction. What are we talking about? What is involved? And yeah, take us down this on this path.
Absolutely. Thanks, John. So, financial information is one of those things that is kind of a daunting thing for most people that are not, business trained. And so it's something that a lot of people don't want to do and they don't like doing.
Yeah.
But the importance of it is just tremendous, right? So
Yeah.
if you understand the finances of your business, it really paints a picture for how the operation is performing.
Okay.
If you've got good financial records and good financial reporting, then it allows you to make decisions to help make better business moves, right? So, if you're tracking your sales, for example, and you can see, one customer segment I'm doing better in than other customer segments, then it'll allow you to focus more of your resources on getting customers in that way.
Okay.
If you're tracking the profitability of certain customer segments, it'll allow you to do the same thing and focus more on more profitable categories of business, and not focus so much on things where you're not making as much money. You can see it from advertising spend is another perfect example of this. If you've got good financial information, you can see that it costs me $100 to get this kind of a client, and so you can know to focus less on that and more on one that you can get for $20 a piece.
Yeah.
So it really is good from an operational standpoint that it helps you to make decisions. It'll also help you, get financing from banks. If you have partners, people that are helping you finance the business, they're definitely going to be interested in knowing, what the performance of the business is and what things are working, what things are not working.
Yeah. That's exactly right. So the more clear or accurate your financial data is, the better you're going to be able to identify trends in the market or make specific strategic decisions and then communicate that to stakeholders and investors, just like you said.
Right.
Okay, so let's start by understanding the main financial statements. What does that involve? What are those and what do they mean?
So there's really 3 primary financial statements that people are concerned about. It's a balance sheet, an income statement, and a cash flow statement.
Okay.
So diving into what those are, a balance sheet it's basically a snapshot in time of what it is that I own and what it is that I owe. So my bank account is going to be an asset. Any money that's owed to me from customers is going to be an asset. any, computers or equipment, things like that I own are going to be assets. So then on the other side of the equation is going to be things that you owe. They're going to be things that you owe that you haven't yet paid, right? So it's going to be, I know that if I've got a credit card, for example, and I have a $5,000 balance, that's something that I owe that I'm going to have to pay. If I have credit with vendors and I have invoices from them that are not yet paid, those are things that are owed.
Okay.
And then the difference between what your assets are and what your liabilities are is your equity. And so what this does is it shows basically what the financial position of your company is at any given time. If I have greater assets than I have liabilities, that's generally considered to be a positive thing, right? That means that you have positive equity in the business. If you owe more money than you have, then that's generally considered to be a bad thing.
Okay. So that equity is a term that represents the owner's stake in the business?
It's basically just, equity is something that everybody's familiar with in terms of like a house. And so, it's a good way to think of it. If I owe $200,000 on my house and it's worth $400,000, then I have $200,000 of equity. And it's the same thing in a business.
Okay. All right. Okay. So, yeah. So that's the balance. That's the balance sheet. Okay. So after the balance sheet, we've got the income statement. So help us explain what role that plays.
So in contrast to a balance sheet, which is a snapshot of where I am today or at any given point in time, an income statement tracks your performance over a period of time, over a month or a year or, a quarter. And what it is simply it's the amount of money that you brought in versus the amount of money that you spent out. So, all of the revenue that I'm generating from my various business lines is my income. And then the next component of that is going to be my cost of goods sold. So cost of goods sold are direct costs that are related to, whatever product or service it is that you're providing. So if I make sunglasses and sell them, then it's the cost that it takes me to buy the sunglasses. And it's all of the costs that it takes me to buy the sunglasses. I'm not just purchasing them, but it's also shipping them, receiving them from my supplier and also shipping them out to the customers.
Okay.
So the difference between your sales and your direct costs is called gross profit. And that's basically how profitable whatever the thing is that you're doing is. Then the third component of the income statement is called your operation expenses. Sometimes it's referred to as OPEX. And that's just the expenses that it takes to run the business, aside from actually selling your products. So that's things like rent, cell phones, utilities. Yep. Just if I turned off my business right now and didn't sell anything, these are the expenses that I'm going to have regardless, unless I want to actually close the business down.
Okay. I think it's fair or probably a good idea to mention to everybody that another name for the income statement is the profit and loss statement, right? So that really
that's probably the more commonly known. Yeah, that's probably the more commonly known.
And remember, in market speak jargon, it's a P&L, right? It's a P&L, right?
Correct.
I think yes, someone could absolutely be confused by that. Okay, so let me ask you a question. Do service businesses have COGS? Do they have cost of goods sold? What are their costs? If I'm a consulting business and I'm sharing my knowledge, I'm sharing my technique, my skills, what are my costs? What are our costs in that kind of scenario?
So that's a great question. Cost of goods sold, they still exist for pretty much every kind of business. I'm trying to think of an example of a business that doesn't have cost of goods sold, and I'm not really thinking of anything. There's always going to be some sort of a cost of goods sold. Advertising is a good example. If I'm trying to advertise to people to get customers, I would call that probably a cost of goods sold. Your equipment, your computer, internet connection, in that instance is probably going to be a cost of goods sold because that's what I need to be able to actually deliver my service to people.
Great.
Travel is a good example of what would be a cost of goods sold if you have to travel out to see your clients.
Okay, great. Yeah, and we could discuss, the limitations or the opportunities with all that on in another discussion. I bet you that would be interesting.
Right.
So finally, what about the income statement? What can you tell us just basically what is it for? What can we get from it?
So the income statement is extremely important because it basically tells you if you're making money or not. It is a profit and loss statement. It says, is the business that I'm engaging in, is it making me more money than that's costing me? I mean, that's in a nutshell what it is, right? I mean, I'm profitable. I'm selling something and I'm making money at it, or I'm selling something and I'm losing money at it, which is, probably the most important aspect of what your business is. And there are times in business where, it may make sense to lose money for a period of time if you're growing your customer base or trying to do things like that. But over the long term, it's got to be profitable. Otherwise, there's no point in doing it.
Mm-hmm. Yeah, it brings up or causes me to think about the Uber or Netflix or startup businesses, maybe Airbnb at one stage, right? They had lost money for years and years, but the long-term picture was good, so they were able to keep going, as potentially using their income statement as a tool. So from my notes, I'm seeing that the income statement is allowing you to sort of see any trends in your revenue and your expenses, identify areas where you could improve, and then it would help you make decisions about how to, better your profitability.
Absolutely. Trend analysis is one of the most important aspects of an income statement, particularly from a revenue standpoint. I mean, as small businesses, generally we're interested in growth, right? So if you pull up your income statement and you look at what I've been doing for the last 6 months, ideally you would see an increase every month, right? So since your cost of goods sold are related to your revenues, you're also going to see a growth there. And then, so here's where you get the benefit of scaling business. As your revenue and your cost of goods sold grow, your operating expenses should probably not increase, right? So my rent shouldn't increase. My utilities shouldn't increase. My cell phone bill shouldn't increase. So what I'm doing is I'm increasing the gross profit by generating additional revenue, but I'm keeping my operating expenses the same. So the delta there should be that I'm getting more profitability as I grow my business.
Okay, good. All right, nice. So we've had the balance sheet, then we discussed the income statement. Tell us about what's the third element of the most important. There's 3 aspects, right? What is the third one?
The third one is a cash flow statement. And basically what it does is it says, it takes and matches up your income statement with your P&L. It matches up your P&L with your balance sheet. And it says this is why, it connects the two.
Okay.
So in businesses where I use heavily credit, right, primarily supplier credit, or I offer terms to my customers, what this does is it says, okay, I sold $10,000 worth of services or goods to my customers, but I haven't collected that money yet. That's going to show up in your cash flow statement. Similarly, if I'm buying products on terms from my suppliers and I don't have to pay for them right when I buy them, that will also show up on your cash flow statement. So there's oftentimes going to be a difference in timing between when you purchase something and when you actually have to pay for it. So the cash flow statement basically just illustrates how well you're managing the differences between the timing of paying for things and receiving money for services that you've provided. So for most small businesses, it's the income statement is going to very closely reflect the cash flow statement. If you're in a business that's, relying a lot on inventory and you have terms and things like that with customers and vendors, then the cash flow statement becomes extremely important.
With credit terms.
Correct.
Okay, because there's some delay between, right? This is, I suspect, the rise of something like last in, last out, or first in, first out, or something.
Yeah, I mean, those are some of the
Terms.
details about how you track inventory and things like that. But so this can kill a lot of businesses if it's managed incorrectly, and it manifests itself, and it's able to be seen in the cash flow statement. So I'll just give you a quick example.
Yeah.
If I'm selling sunglasses and I buy them from my supplier and I have 30-day terms with that supplier, but then I'm turning around and selling them to somebody else and I'm giving them 45 days terms. That means I'm having to pay within 30 days of getting the product, but I'm not receiving my money until 45 days. So that'll put a company out of business faster than anything. So what you want to try and do is flip that around, and you want to say, I'm going to pay for these from my supplier in 45-day terms. And then when I sell them to my customers, they're going to pay me in 30-day terms. So then what you're doing is you're actually building up cash flow every month. And every time you turn, you're actually getting additional cash flow even beyond what shows up on your P&L.
Okay, so the conclusion is the cash flow statement is going to connect the balance sheet and the income statement, and it's going to give you some idea of the health of the ongoing business. Is that accurate?
Yes, it shows the health of your ability to manage the cash flows within the business.
Okay, the ability to manage the cash flows. Okay. All right. So we've got those three things. Now, are there any other comments or advice or additional information that a small business person needs to get started with those, or to manage those, or to deal with those?
There's not any specific advice I would really give beyond what we've already done. I mean, everybody needs to have an understanding of their P&L, their income statement. It really shows how the business is performing. For 90% of the people that would see this, that's the most important one. So you should have a good understanding of what it is. Take some time to get an understanding of it. Talk to your CPA if you need help understanding it. Have a good knowledge of it and look at it regularly.
Okay. Yeah, absolutely. Like we've been talking, planning, scheduling, routines, being active about these things, seeking them out. Yep, they're definitely part of the thing about doing business that we don't enjoy so much, I suspect. But I think we need to encourage the people who are listening to us speak, small business people, that this is crucial, that they start from the beginning, that they get set up early and become comfortable with it, because I think that it's going to become critical to their success. Okay. So with the three biggies sort of out of the way, now we discuss kind of some maybe some financial vocabulary that might be difficult to understand or unclear for small business people. What are some of those terms, Mark? Can you run down the list of the most central core financial terms that a small business person should understand?
One thing that's really common in business is using financial ratios to kind of judge the health of the business.
Okay.
And what those ratios are is they're basically just percentages of things that give a demonstration of how profitable the business is, how well the company is managing its assets.
Mm-hmm.
So there's about five that are really there's 4 or 5 that are really key.
Okay, let's go one by one and check each one out.
Sure. So I'll just run down the list. You've got a current ratio, you've got a gross profit margin, a net profit margin, and then your debt to equity ratio. Okay. So 2 of these are, ways of looking at how profitable the business is, And then the other two are kind of a judge of where the business is from a financial standpoint. So your
Okay.
current ratio is something that banks look at a lot. And what it is basically is it's the assets that I have right now that are either cash or will quickly turn into cash versus what are the short-term liabilities I have? What are the credit cards that I owe? What are the accounts payable that I owe? And so it's just a ratio that says it's my short-term assets divided by my short-term liabilities. And generally, it's considered that if that ratio is more than 1, then you're in a good position. And the higher above 1 it is, the better. So if I have $1,000 in assets and $5 and $500 in liabilities, then my current ratio is 2.
Of 2. Okay. Yeah. Okay.
So that's good. If I have short-term assets of $500 and I have short-term liabilities of $2,000, that's bad. Because it means I don't have enough. It means I don't have enough liquid resources to cover my short-term liabilities.
All right. So we can't look at these. We definitely can't look at these in isolation, I suspect, because they won't give the full picture. But definitely, it's one part of the story. Okay, so that's easy enough to understand. Current ratio is your current assets divided by your current liabilities. Okay, so what's the next one?
So the next one I'm going to talk about is also a balance sheet related ratio, and it's your debt to equity ratio. And people are probably familiar with this concept too, because it applies to personal credit, right? So it's the same situation in a business. It's how much money do I owe versus how much equity do I have. So equity, we talked about, it's the difference between how much I have and how much I owe. So the bigger, again, that number, the better. So if I have $200,000 in equity in my house and I owe $200,000, that's pretty good. If I have, if I'm upside down on my house and I owe more on it than it's worth, that's bad. That's a debt to, so that's your debt. That's essentially what your debt to equity ratio is.
Okay. So how much you owe with how much equity you have. So how can that be represented in a product based business? So let's not talk about the housing example, but so I've got widgets and they're everyone loves them. I've got them on Amazon. I'm selling them on Etsy. I'm selling them at the local, flea market, et cetera, et cetera. Where's my equity there? What is equity in that kind of scenario?
So your equity in that scenario it's basically an accumulation of what your profits have been over time, right? So it is, it basically just shows how much more money have I made than I have spent to sell these widgets, right? So that's what your equity is. That is what your equity is.
Okay. So it's the profit. It's profit.
It's basically all of the historical profit of the business.
Okay. That's good to know. All right. So these first two are, you said balance sheet related, right?
Yep.
Okay. So what about the next two?
So I already hit these two a little bit, but I'll just go into a little bit more depth. Gross profit margin it's the percent of profit that you make from selling a product less what the actual costs are to get it out to people. So this is going to be a lot higher in a service business. You alluded to this earlier. There's not as many cost of goods sold in a service business. So the gross margins in that are going to be a lot higher. If you have employees that are helping you provide the service, then you've got to put the cost of those employees in there. So that's going to make your gross profit margin go down. But a product related business is going to have much lower gross profit margins too, because you have to buy the things that you're selling to people.
Yeah. Absolutely.
And there's not, it's people ask what a good profit margin is, and it really depends on your industry and in what your specific business is. And
are there any benchmarks in your experience?
It's so industry specific that it's
rule of thumb.
It's so industry specific that it's hard to give something like that. I mean, if you're doing a service business, it should be probably 90%. If you're doing a, like a manufacturing business, you're going to be,
Be down
looking
to
at probably 30 to 35% is what your gross margins are going to be.
Okay. Is there any scenario where the gross margin could be very small, yet the company could be, quite robust from a financial standpoint?
There are really not examples of where your gross margin would be small. Your gross margin is really what it allows you to pay for all of the overhead of the company. And if you have a small gross profit business, it's probably not a very good business.
Okay, so so we're talking about OpEx, right? You're talking about the overhead. Yeah. So this is the rent. This is
the rent, and this is the, it's the phone bill and the lights, and it's the owner's salary. It's all of that stuff. So if you have a business that produces a low gross profit, you should probably do something else.
Okay. Yeah. Very interesting stuff. Especially when we look at some of the companies out there, how they might make money on what. That's quite fascinating to see. I sense that commoditized businesses, and what I mean by that is maybe what do you think about a company that sells refrigerators or light bulbs? Where does that business get its mojo, so to speak? Like,
so those are tough businesses. And they are volume. One of the things
volume
that kind of
businesses.
Yeah, that's the only way a business like that can ever make any money. Something that, commodities is a good example. Farms, they probably have pretty low gross margins. Restaurants have pretty low gross margins. And these are all businesses that have a really, really high failure rate, right? So if you don't have a high gross margin, you're going to be in a really, really tough spot.
Wow. Yeah. Yeah. The restaurant example is really, really interesting. Okay. So this is income statement related. Yep. So what's the final one? The final one is debt. Is it? No. Final one is net. Yeah. Just net profit margins, right?
So net profit margin it's the gross profit less whatever it is that it takes to run the business. These are the rent, the lights, your salary,
and the COGS.
And the COGS. It's the absolute bottom line. It's what you have at the end of the month from what it costs you to run the business from what you sold on it. And so net profits are obviously going to be a lot lower than net profit margins. There are some better rules of thumb on this one. If you're making less than 10%, you need to really evaluate what you're doing.
Less than 10%, huh?
Yeah. That's a pretty good rule of thumb. It really kind of boils down to, what it is that you're comfortable with and what it is that you're happy with. But if you invest money in the stock market, the S&P 500 averages an 11% return. So if your business is making less than that, you'd be better off to take the money that you invested in your business and just put it in the S&P.
Oh, goodness. Yes. All right. Yeah. The background of the current situation as we speak is that the financial markets have just taken off recently, right? There's some good news about inflation potentially, right? And so I just saw that the markets have been really going a lot higher recently.
Right.
Okay. So we talked about these kind of core financial statements, and then we also went over the most important financial ratios. So there is another key aspect of this, and that is financial reporting and information.
All right, everybody. This conversation went a little bit longer than we were anticipating. So we're going to go ahead and take this and we're going to cut it into two. So we're going to end this recording now. And then in part two, we will finish up our conversation about financial reporting basics.